Modern portfolio theory, efficient frontier, and capital market line. Modern portfolio theory, MPT, developed by Harry Markowitz in the 1950s, introduced a quantitative method for optimizing portfolio returns while minimizing risk. Key MPT concepts include the efficient frontier and the capital market line, which guide investors in constructing optimal portfolios. Efficient frontier. The efficient frontier represents portfolios that maximize expected returns for a given risk or minimize risk for a given return. This concept highlights the risk-return trade-off in portfolio management. Constructing the efficient frontier. Risk and return. Investors estimate expected returns, variances, and covariances of assets. Returns are the weighted average of individual asset returns, while risk is measured by return standard deviation. Optimization. By applying optimization techniques, investors find optimal asset weights that define the efficient frontier on a risk-return graph. Characteristics of the efficient frontier. Shape and slope. The upward sloping curve indicates that higher returns typically involve more risk. Diversification. The efficient frontier underscores diversification's role in reducing risk while enhancing returns by combining assets with different risk-return profiles. Capital market line, CML. The capital market line, CML, represents the risk-return trade-off for efficient portfolios that include a risk-free asset and a market portfolio. It extends the efficient frontier to incorporate the risk-free rate, providing investors with a comprehensive tool for evaluating portfolio performance and making investment decisions. Understanding the CML, risk-free rate. The risk-free rate is the return on a theoretical asset with no risk, such as short-term government securities. By combining the risk-free asset with the market portfolio, which is an efficient portfolio that includes all risky assets, investors can achieve a range of portfolios with different risk-return profiles. Calculation. The CML is derived from the Capital Asset Pricing Model, CAPM, and is represented by the equation expected return, where RF is the risk-free rate, RM is the expected return of the market portfolio, SM is the standard deviation of the market portfolio, and SP is the standard deviation of the portfolio. The slope of the CML represents the market price of risk, indicating the additional return investors can expect for taking on additional risk. Implications of the CML, optimal portfolio. The point where the CML is tangent to the efficient frontier represents the market portfolio, which is considered the optimal risky portfolio. Portfolios that lie on the capital market line offer the best possible risk-return combinations when incorporating the risk-free asset. Investment strategy. Investors can choose portfolios on the CML depending on their risk tolerance. By mixing the risk-free asset with the market portfolio, investors can adjust their overall portfolio risk while still achieving optimal returns. For example, a conservative investor might hold a larger proportion of the risk-free asset, while an aggressive investor might allocate more to the market portfolio. Applications in portfolio management. Modern portfolio theory, MPT, using the efficient frontier and capital market line, CML, provides a comprehensive framework for portfolio management, aiding in asset allocation, risk management, and performance evaluation. Portfolio construction. The efficient frontier helps investors identify portfolios with optimal risk-return profiles, allowing them to select options that maximize returns for their chosen risk level. Performance evaluation. The CML serves as a benchmark. Portfolios above it deliver superior risk-adjusted returns, while those below are less efficient. Risk management. MPT principles support diversification and optimization, enabling investors to align portfolios with their risk tolerance and goals. Asset allocation models. Diversifying and optimizing portfolios. Effective asset allocation balances risk and return by diversifying across asset classes. Various models contribute to efficient portfolio management. Strategic asset allocation, SAA, establishes long-term asset class targets based on an investor's risk tolerance, time horizon, and objectives. Setting targets. Investors allocate percentages to asset classes like equities, bonds, and real estate, using historical performance and expected returns. Rebalancing. As asset values shift, periodic rebalancing realigns the portfolio with target allocations, maintaining the desired risk-return balance. Tactical asset allocation allows investors to adjust portfolios based on short-term market conditions, unlike strategic asset allocation, SIA, which is focused on long-term goals. Market timing, TAA, involves making adjustments based on market signals like economic indicators or interest rates. For instance, an investor may increase equity exposure during expected growth periods or shift to bonds in anticipation of a downturn. Active management, TAA, requires frequent portfolio adjustments, potentially enhancing returns but adding risk due to reliance on timely analysis. Dynamic asset allocation, DAA, is a flexible strategy that adapts to market changes and the investor's financial situation, lacking predefined rules. Adaptive strategies adjust asset allocation in response to market volatility or changes in the investor's risk profile, aiming to reduce risk as conditions shift. Risk management. By modifying allocations based on market trends, DAA helps manage risk and protect capital. Monte Carlo simulation models potential outcomes of various asset allocations, aiding investors in assessing goal feasibility. Simulation process. It generates random samples of asset returns to explore possible outcomes, providing insight into the risk-return profiles of different strategies. Scenario analysis. Monte Carlo simulation shows the probability of meeting goals, guiding allocation adjustments for desired financial outcomes. Efficient frontier, MVO, plots the efficient frontier, displaying portfolios that offer the best risk-return combinations for specific investor goals. Optimization algorithms. Algorithms like quadratic programming analyze historical returns and covariances to identify the most efficient portfolio. Understanding risk and return, defining risk and return. Return represents the gain or loss on an investment over time, expressed as a percentage. It may include dividends, interest, and capital gains. Investors aim to maximize returns to meet financial goals. Risk refers to the uncertainty of returns, including the possibility of loss. It's measured by statistical metrics like standard deviation or variance to quantify variability. Risk-return trade-off. The risk-return trade-off suggests that higher returns generally come with higher risk. Investors evaluate their risk tolerance to determine an acceptable balance between potential returns and risk. Evaluating risk-return trade-offs. Expected return and risk measurement. Expected return, the weighted average of possible returns, representing what an investor anticipates over time. Risk measurement. Standard deviation measures return dispersion, while beta and value at risk, VAR, assess systematic and potential losses. Balancing risk and return. Diversification. Spreading investments across asset classes, sectors, or regions reduces the impact of any single asset's poor performance, managing risk without necessarily reducing returns. Risk tolerance and investment horizon. Risk tolerance varies based on goals and preferences, with higher tolerance allowing for riskier investments. Investment horizon. A longer horizon allows for more risk, while a shorter one may require conservative strategies to preserve capital. Applying risk-return trade-offs. Portfolio optimization involves selecting an optimal mix of assets to achieve desired risk-return levels. Tools like the efficient frontier and mean variance optimization aid in asset allocation decisions. Adjusting for market conditions, investors may adjust portfolios in response to economic changes, like interest rates or market volatility, to align with the prevailing risk-return trade-off.